big tech earnings, I was surprised that investors got as aggressive in bidding up those stocks after, Meta says we're going to do some cost cuts. We're going to, doing this, that, and the other. And the reason is because, the huge tidal wave of the pandemic that has been driving these companies forward, that's receding. We're going to go back to normal. I look at things like Amazon, and when you have the kind of volume of online traffic that we had as people were kind of stuck at home or working from home, you're also seeing more and more people needing to go back to the office because their bosses are demanding it. All of that means that spinning over to more and more servers at their big data farms, spinning over to use more capacity, that's no longer nearly as big an issue. And so that means that demand, they built up to take that capacity during the pandemic. Now the demand for that capacity isn't as robust. And, companies like ours are seeing pretty good deals for adding capacity when we need it because there's a lot of idle out there. So I think the tech earnings, easy to understand, and harder to understand why people didn't see it coming. The thing that has surprised me is consumer staples and some of those other names that are showing huge earnings because they're making inflation work for them. The pricing power that you're seeing from boring old consumer staple companies and so forth, I think it's a combination of, they're having pricing power at the grocery store. They're able to get those price increases through, and their wage increases are robust compared to the last 20 years, but they're smaller than the price increases that they're able to push through. And that's creating operating leverage, and that's dropping down to their bottom line. Kind of trying to look through the non-farm payroll numbers it's got to be, look, is the job market in good shape? Yes. Is it in 500,000 jobs a month kind of shape? No. So, clearly what's happened is American companies have fought long and hard to get workers for the last 2 years. Now that they've got them, they're not inclined to lay them off as inconsistent with historical patterns. If you look at where the big job gains came from today's non-farm payroll, it was in retail, it was in hospitality. These are the areas where the seasonal adjustments for non-farm payroll expect big layoffs in January after the Christmas season is passed. Those layoffs didn't happen, so I think there was a bit of a phantom seasonal adjustment boost to these numbers. And I think the investors at first were saying, hey, this is seasonal adjustment. No one can panic about this. And then they started thinking about the revisions to prior numbers. They looked at the revisions to prior wage gains, and also the larger picture of, we can try and debate about whether or not the market or the economy is as strong as the headline number would suggest. But given how the Fed has been monotonically focused on an unbalanced labor market, this headline number is arming the hawks to keep driving rates higher. And it's taken a lot of the wind out of the sails for the doves who are trying to point at declining inflation as a motivator for future policy.